Good evening, all. Ira Epstein with your metal market wrap-up, and this wrap-up is for a wild trading day on this Wednesday, the 5th of January, 2022. Almost got my dates mixed up there, and the time about 6:10 p.m. Central Time. So today was the FOMC minutes, and the market's using that as the excuse as to why everything fell apart after they came out. I'm not convinced that was really it. It was the catalyst for a market that had been extended through the month of December, talking about the year-end rally, if you would get that. Then when would it end? I kept pointing out that Yale Hirsch has always said it's through the first two trading days of the year, and not every index went up and made new all-time highs. Two of them certainly knocked on the door, but you'd been weak anyways in the NASDAQ, and you've been weak in the Russell, and interest rates are part of that. You know, interest rates keep going up. You went over 171% today, yet the dollar didn't rally on that news. The dollar's viewing the high interest rates as a negative, not a positive. It's not the wind behind its back pushing it forward. It's saying, wait a minute, if they keep raising interest rates, the economy is going to get hurt. Economy gets hurt. Is that really good for the U.S. dollar? The market has taken a leap of faith and said in one meeting that now we're going to get 3 to 4 interest rate hikes. This is what I think analysts are thinking in 2022. And that the balance sheet runoff is going to be immense and happen right away. Number one, it doesn't work that way in the balance sheet runoff. If they wanted to begin it, it would take over a year to accomplish. And they'll do it in stages. The Fed does not become fickle. Do not read that about our Fed. Our Fed walks a fine line. And if you're trying right at the beginning of the year to put all these reasons together, let me just say this. Markets go up, markets come down, and this Fed is going to look for economic data. A tight labor market, yes, but you're putting more people to work. Let's remember that. Watch Friday's jobs data. We'll see from that a better picture of everything. What if we get big numbers? They're looking for 400,000 new jobs. Let's see what we get. When you look at the gold market, it still has an upside bias, but it is now down for the week 1%. It was up this week most of the time. When we take a look at the chart here, you can see where the market's failing again in this 1825, 1830 level that I'm talking about. You got as high today as 1830.70, couldn't hold it and backed off. Why? Well, let's look at the chart action. You've got the 200 in gray, the 100 in red, the 100 in green, and the 18-day average of closes in the red. They're all together here, so you've got a support package right under the market. That's the first thing. So the traders that bought the first support, you got to bounce. Where did it bounce to? If you look at the Bollinger Band, I mean, you knocked on the door. You got within $3 of it, and the market fell back on you. Okay. You'd have to still take out 1798.10 to break the pattern of higher lows, higher highs. Therefore, the bulls still have the upper hand until that occurs. And if that occurs, then it depends on the settlement. If you get under 1795, you certainly open the door for 1770. You got to prove that you can do that. Momentum-wise, you have been overbought. You never embedded. You've just been in an overbought market that's in need of a correction. A lot of cross currents going in this market. I don't think it's yet saying, oh, I'm picking up and I'm going to run away on you. The gold-silver ratio, well, you can see silver lost to the gold. The higher this number goes, it means you need more ounces of silver to buy an ounce of gold. So as it's come back in the 78 level, 78.50s, 60s, now it's 79.37, that means silver's losing to it. And if you look at the silver chart, like the gold, it is an overbought market with lower highs, lower and low. So that's something you want to pay attention to. In the copper, lower highs, lower lows, and a lost embedded reading. Now watch this. Right here, you're fully embedded. You've got the numbers before this happened today. Both numbers on Tuesday over 80. Both numbers on Monday over 80. And both numbers on Friday over 80. But as the day wore on today, it became very clear you were losing the embedded reading. It happened about 11 o'clock. I was looking at it because originally I wanted to be a buyer of the market, and I yanked those orders for my paid subscribers. I put out, no, cancel that order, and later in the day it hit that price and went through it. And right here, they'd have been behind on the market. Okay. Got lucky on that. I lost on other trades today. You know, you give back at the top of a market something. And that is normal. It's not abnormal, all right? You play the market till it doesn't work. So your last bet is probably going to be the losing bet. Unless you're so smart, you take all the bets off the table. There was no need yet. Today was the day where that came in. So I'm looking for the market to regroup in the 436.75 area, the 18-day average, and work off an overbought situation. In the platinum, this was the easiest call that I could have made. Here's the market. You got stiff resistance at the 100 in the upper Bollinger Band. If you get there, that's where I think the pros will come out. Market got right up to it. I mean, this is classic, and now it's falling back. Okay, and it's not in an uptrend. That's just a solid resistance point. In the palladium market, the market the other day came down right here. You lost the embedded reading. You can see the red lines. Watch, it gets under the 80. The target was here. It all happened at one time. And since then, it's just been holding on, even with everything around it falling apart. And in the dollar, you're void of a trend. You've got a higher high, lower low. So what do we do with all that? Well, tomorrow you're going to come to my webinar. It opens at 12:15. It starts at 12:30. If you didn't get your invite, take your cursor, draw it to the top up here. That's what I want you to do. You're going to see the icon to join the meeting. And what do I mean by that? You're going to fill out a form. When you fill out the form, you will get an invite. It's got your code, your user ID. It is free. It's 20 minutes. Clear your schedule. With a day like today, there's going to be a lot of ground to cover. I expect that we're going to fill up and there might be no seats available. So something you might want to decide what you want to do. As I said, it's 20 minutes. I do not record it for the public. Okay, it is, nor my paid subscribers. You either attend or you miss out on it. It's that simple. I used to record them and put them on the website, and then what people started doing is pretty simple. You know, I'll go see what everybody else was asking Ira, and I'll catch up with it tonight. Well, then the viewers stopped coming in, and I ended up talking to myself for most of it. Didn't like that. So I changed it about midway through last year, and I'm full. All right, and that's what I figured would happen. You know, you can just do so much. So that should be a lot of fun, and we'll talk about what's going on. And by the time we're holding that, we got the whole morning trade behind us. And again, I'm going to be very focused on what happens if you get great jobs numbers, and that means the wage pressure and the tight job market may be easing up a little bit. Things you got to think about. So I'll see you tomorrow. You have a good evening.